Michael Darda with us, MKM Partners. Sometimes research notes stick out like a sore thumb, as his did yesterday. It was short, but it was real. Michael, the 30-year bond, down it goes. What does it signal that the 30-year bond blew through the 2010 low yield?
Hi, Tom. Well, I think it signals collapsing future nominal GDP expectations. This is also showing up in a narrower term structure, or the yield curve spread, which is also collapsing. You mentioned that every morning on the radio. And widening debt spreads. So these are all indicators that are market-based that are telling us that we may be in the throes of a negative velocity shock.
Well, you see the negative velocity shock. Define velocity for us. When you say velocity, what is that?
Velocity is just the ratio of nominal GDP to money. And if you end up with less nominal GDP going forward, velocity tends to fall. So what we've had happen recently is a big rush into risk-free cash assets. So some of the money supply figures have started to surge, but that is not a virtuous cycle of lending and spending going on. Commercial bank credit's been flat for 2 years. What we have instead is a dash for cash and safety, and people holding back, basically. So nominal GDP probably will be growing at a slower pace, and it's already been slow.
Well, that sets it up nicely. Let's look at the velocity chart here. We've entitled it Darda Decelerates, and you can see the velocity. This is, again, the spirit of the economy compared to our money supply, and it rolls over, and it's just rolled over again a little weak down in that right-hand corner. Michael, you talk about nominal GDP. Are you suggesting the Fed needs to make inflation its friend?
Well, Tom, I think it would be better for the Fed to focus on nominal spending instead of just hewing to an inflation goal. Now, that's a controversial view. It's not necessarily shared by the members of the FOMC, including Chairman Bernanke. They did mention nominal GDP level targeting a year or two ago in the Fed minutes, but it really hasn't come up since. And unfortunately, this focus with just a 2% implicit inflation target, I think, is actually going to cause some problems now, because clearly the economy is weakening, the outlook is darkening. But the justification last year for QE2 was really core inflation rates rolling over.
Right.
Last summer, they were sub 2 on a 3-month annualized basis, falling to about 0.4, if I recall correctly. So QE2 was justified on the basis that inflation was below the mandate contingent level, and the Fed acted. So now, if that could be a problem, something that comes up to haunt the Fed with the core inflation readings. And I think this is temporary, but they have jumped up to about a 3% run rate over the last 3 months. And this could make it more difficult for Bernanke to do anything further,
even if he desires to. Quickly here, Michael, and I want to come back. This comes back to Olivier Blanchard at the IMF, suggesting 4% is an inflation to keep the system going while we wait for the debt and financial markets to heal. Are you suggesting that the new inflation target should be 2.5 or 3, or even Blanchard's suggestion of 4%?
Well, Tom, I would prefer that the Fed just focus on overall nominal spending. We've had nominal GDP growth running at a 4.1% average annual pace throughout this recovery. That's very weak after the huge collapse we've had. You really need to see those nominal growth rates up, in the 7% plus range for a while to move the needle on employment. So I would prefer the focus to be on nominal spending, not some specific rate of inflation. In this environment, a higher inflation target may help, but that could actually hurt if the economy has a different set of conditions. You don't want the Fed overdoing things on the other side, where a nominal GDP level target, I think, would help on both.
Michael, would you buy gold here?
No, Tom, I would not buy gold, the precious metal. I think if investors are interested in that sector, they'd probably be better off buying the gold miners, which have underperformed the metal, just playing that divergence. And our strategy team on the option side has actually recommended that investment.
Very good.
Trade.
Michael, research note, let's bring it up here. 15 basis points from recession. The U.S. appears to be in the throes of another negative velocity shock that has been captured by the collapsing Treasury yields. Can a Federal Reserve goose velocity and goose through to nominal GDP? Is there a history where they do that?
Well, sure. I mean, any central bank that has a fiat currency, which is all central banks in this environment, has the ability to affect nominal GDP growth. That's what they can control. So if a central bank is doing its job, essentially it's offsetting those velocity shocks and keeping nominal GDP on a stable growth path. It's difficult to do when the financial system is turned upside down, when you have a banking crisis, as we've had, when you get shocks from overseas monetary policy errors, as we're now having vis-a-vis Europe. But certainly the ability is there. Is the willingness there? Are the tools there? That's a different question.